Hello, Oracles. I know I'm jumping on a little early. Had an opportunity to get back on here early. So Jerome Powell should be on in about 5 minutes or so. Looks like they did raise the rates 50 basis points is what we expected. And we'll see what Jerome Powell said. I have not had a chance to read through the entire um, note that he had presented out there. So I'm going to be diving through doing some things on my phone while we watch this, go through Twitter, get some other information for you guys as Jerome Powell is speaking. And I will be responding to you guys in the comments. But I'm not going to talk through this so we can hear what Jerome has to say for us. So I hope everybody's having a good afternoon. Looks like on the news, everything tanked pretty hard. We were up green in the indices. Tesla was down because it just is. But it looks like, the last few times, other than the last meeting, the first few, we had this same situation happen. The whole market kind of tanked going into the FOMC meeting. And then as Jerome Powell spoke, the market started to rally. So who knows what's going to happen here? Again, this is just another step along the way, but don't forget, this is the seventh rate hike in a row. And the last, was it 5? I think were 75 basis point hikes. So now we're coming down. This is only a 50 basis point. So again, inflation's coming down. We are moving in the right direction. So Moon, yes, definitely buying the dip for sure. I added more yesterday. I'm going to add when we get down to maybe that 155 level again. We got pretty close, 155.82. I'll probably throw in a little bit more, but I'm still saving cash. I actually sold Nvidia yesterday. I broke even on it, and I only had one share, so I just wanted to free up some cash. So I've got enough cash, so I'm going to start deploying more and more into Tesla. But with all the drama that's going on, I really don't know what's going to be going on. Actually, while we're waiting, I'll do this. Good. There's going to be no volume coming out from Jerome Powell's not speaking. So let me know if you guys can hear everything. If you can hear me, then you should be good with the volume over there. And I'm trying something. Okay, we're good now. Okay, awesome. Thank you. Yeah, sorry, I was trying to switch back and forth between microphones because I know that the speaker for my laptop is actually better for when I'm playing videos. So I switched to that. Let's see. Yeah, it looks like we're hovering around that 157. I was trying to figure out how to get the stocks, the ticker on the screen with the video. I'm sure I can. I can't figure it out, but all right, here comes Powell. I'll keep quiet now.
Good afternoon. Before I go into the details of today's meeting, I'd like to underscore for the American people that we understand the hardship that high inflation is causing and that we are strongly committed to bringing inflation back down to our 2% goal. Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by a half percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive policy stance for some time. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of the longer run normal growth rate. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a half percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term in response to many factors, but it is important that over time they reflect the policy restraint that we're putting in place to return inflation to 2%. We're seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a half percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You just talked about the importance of market conditions reflecting the policy restraint you put in place. Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High yield credit spreads have come in. The economy has accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that? And how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year, but our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves, and many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP again for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more in the fives. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that we're published shows again that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up. And it could move down if inflation data are softer.
Gina Smilik, New York Times. Thanks for taking our questions. The SEP, like you mentioned, suggests that the Fed will be making another 3/4 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed playing out going forward. And then I wonder what you're looking at as you determine when to stop.
As I've been saying, as we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw how strong inflation was and how persistent, it was very important to move quickly. In fact, the speed, the pace with which we were moving was the most important thing. I think now that we're coming to the end of this year, we've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed. So, and that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy. And that'll be the key thing. But for that decision. But ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough. I told you today we have an assessment that we're not at a restrictive enough stance, even with today's move, and we've laid out our individual assessments of what we would need to do to get there. At a certain point, though, that we'll get to that point, and then the question will be, how long do we stay there? And the strong view on the committee is that we'll need to stay there, until we're really confident that inflation is coming down in a sustained way, and we think that will be some time. Now, why do I say that? If you look at that, you can break inflation down into three sort of buckets. The first is goods inflation, and we see now, as we've been expecting really for a year and a half, that supply conditions would get better, and ultimately supply chains get fixed, and demand settles down a little bit and maybe goes back to services a little bit, and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up, actually, as rents expire and have to be renewed. They're going to be renewed into a market where rates are higher than they were when the original leases were signed. But we see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE and core inflation index, is non-housing related core services. And that's really a function of the labor market largely. At the biggest cost by far in that sector is labor. And we do see a very, very strong labor market, one where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now, after not turning at all for a year and a half. Now it seems to be turning, but there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it, so that we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates and why we're expecting that they'll have to remain high for a time.
Howard Schneider with Reuters. Thanks for taking the question. You described GDP growth in the SEPs as moderate or modest, I believe. Yet it's really approaching stall speed. Half a percentage point is not much. You described labor market unemployment rate as representing some softening, but it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed?
Well, I'll tell you what the projection is. I don't think it would qualify as a recession, though, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about a half a percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself. Generally, companies want to hold on to the workers they have because it's been very, very hard to hire. So, and you've got all these vacancies out there far in excess of the number of employed people. That doesn't sound like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what their forecast reflects.
Thanks, Nick Tamaros of the Wall Street Journal. Chair Powell, I want to follow up on Gina's question. The decision to step down the pace of rate rises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting. But what you said is broadly right, which is having moved so quickly and having now so much restraint that's still in the pipeline, we think that the appropriate thing to do now is to move to a slower pace. And that will allow us to feel our way and and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
With the CPI report that did come out last week, do you think it would change some of those forecasts in today's estimate?
No, absolutely not. No, as a just a matter of practice, the SEP reflects any data that comes out during the meeting, and participants know that they can make changes to their SEP during the meeting, well in advance of the press conference, so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the models suggest that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now, we've continually expected to make faster progress on inflation than we have ultimately. And that's why the peak rate for this year goes up between this meeting and the September meeting. You see the fact that we've made less progress than expected on inflation. So that's why that goes up. And that's why unemployment goes up, because we're having to tighten policy more. And so it didn't go up by much in the meeting, I don't think, but that's the idea, is slower progress on inflation, tighter policy, probably higher rates, probably held for longer, just to get to where the kind of restriction that you need to get inflation down to 2%.
In order to get to that number, how much of that could be caused by layoffs versus vacancies trimming or changes to the labor force population rate?
It's very hard to say. You can look at history, right? And history would say that in a situation like this, the declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there, where there are 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies will hold on to workers, and it means that it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically, but I think that's a reasonably possible outcome, and you do hear many labor economists believe that it is. So we'll see, though.
Thank you. Colby Smith with the Financial Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be higher than the 5.1 medium estimate penciled in?
Well, I think that's why one of the reasons it went up was that core came in stronger this year. Yeah, what you see is our best estimate as of today, for how high we need to raise rates, to how much we need to tighten policy to create enough restrictive policy to slow economic activity and soften the labor market and bring inflation down through those channels. That is the estimate, best estimate we make today. And as I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing, but we don't publish it.
Hi, Victoria Guida with Politico. I wanted to make sure I understand specifically what's going on in the SEP, because you all expect rates to go higher, but you're also more pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily because of wage growth, that you expect wage growth to be sort of a headwind?
And we're going into next year with higher inflation than we had thought. Right. So we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation is running now, well more than a 1% change in inflation. But remember that the jump off point at the beginning of the year is higher. So we're moving down still by a very large chunk. I don't think the policy is having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down. I believe the median is 3.5%. That's a pretty significant drop in inflation. And where's it coming from? It's coming from the goods sector, clearly. By the middle of next year, we should begin to see lower inflation from the housing services sector. And then, the big question is how much will you see from the 55% of the index, which is the non-housing services sector. And, that's where you need to see, we believe you need to see a better balancing of supply and demand in the labor market, so that you have, it's not that we don't want wage increases. We want strong wage increases. We just want them to be at a level that's consistent with 2% inflation. Right now, if you factor in productivity estimates, standard productivity estimates, wages are running, well above what would be consistent with 2% inflation.
Thanks. Hi, Chair Powell. Neil, Neil Irwin with Axios. Some of your colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP. But futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
You know, our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time. Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
Steve Matthews with Bloomberg. Let me ask you about China. In the last few weeks, China has abandoned its COVID policy and been reopening pretty strongly. I'm wondering if you see that as disinflationary because you're seeing supply chains improve, or inflationary because it obviously brings a lot more demand globally, improves the global outlook for growth and for commodities prices.
And so you're right. Those two things will offset each other. Weaker output in China will push down on commodity prices, but it could interfere with supply chains ultimately, and that could push inflation up in the West. It's very hard to say, how much how those two will offset each other, and it doesn't seem likely actually that the overall net effect would be material on us. But to your point, China faces a very challenging situation in reopening. We've seen waves of COVID all around the world can interfere with economic activity. China, a very critical manufacturing place for manufacturing and exporting. Their supply chain is very important. And China faces a reopening. They've backed away from their COVID restriction policies. There could be very significant increases in COVID, and we'll just have to see. It's a risky situation, but again, it doesn't seem like it's likely to have material overall effects on us.
Hi, Chris Rugaber, Associated Press. Thank you for taking my question. I wondered if you could comment a bit more about yesterday's inflation report. I mean, it showed inflation cooling in all three of the categories that you laid out at Brookings. Are you confident that you're seeing real progress on getting inflation under control? Are you still worried it could slip into some kind of unentrenched, upward spiral? Thank you.
Right. So the data that we've received so far for October and November, we don't have we have some remaining data to get in November, but they clearly do show a welcome reduction in the monthly pace of price increases. As I mentioned in my opening statement, it will take substantially more evidence to give confidence that inflation is on a sustained downward path. So the way we think about this is this. This report is very much in line with what we've been expecting and hoping for. And what it does is it provides greater confidence in our forecast of declining inflation. As I mentioned, we've been forecasting significant declines in overall inflation and core inflation in the coming year. And this is the kind of reading that it will take to support that. So really, this gives us greater confidence in our forecast rather than at this point changing our forecast. In terms of the pieces, we have been expecting goods inflation to come down as supply chain pressures eased. That's happening now. Housing services, as I mentioned, there is good news in the pipeline. As long as new housing leases show declining inflation, that will show up in the measure around the middle of next year. So that should help. And the big piece, again, is core services ex housing, which is very important. And we have a ways to go there. You do see some beginning signs there, but ultimately that's that more than half, as I mentioned, of PCE core index. And it's very fundamentally about the labor market and wages. If you look at wages, look at the average hourly earnings number we got with the last payrolls report. You don't really see much progress in terms of our average hourly earnings coming down. Now there may be composition effects and other effects in that, so we don't put too much weight on any one report. These things can be volatile month to month, but we'll be looking for wages moving, down to more normal levels where workers are doing well and ultimately their gains are not being eaten up by inflation.
There's a, excuse me, Michael McKee from Bloomberg Radio and Television. There's a little bit of a disconnect between the optimistic view you just expressed about the economy and the changes that you've made in the SEP. And I'm wondering if you're reacting to the fact that the markets have loosened financial conditions, or if you feel the Fed may be a little bit behind on inflation, whether in the recent disinflation we're seeing is transitory or not, and how this affects the idea of a soft landing if you're projecting just 0.5% growth for this year.
So if I think I got your question. So, one thing is to say is I think our policies in getting into a pretty good place now. We're restrictive, and I think we're getting close to that level of sufficient. We think sufficiently restrictive. We laid out today what our best estimates are to get there, it boils down to how long do we think this process is going to take. And of course, we welcome these better inflation reports for the last 2 months. They're very welcome, but I think we're realistic about the broader project. So that's all. That's the point I would make. It's, we see goods prices coming down. We understand what will happen with housing services, but the big story will really be the rest of it, and there's not much progress there, and that's going to take some time. I think my view and my colleagues' view is that this will take some time. We'll have to hold policy at a restrictive level for a sustained period, so that two good monthly reports are very welcome. Of course, they're very welcome, but we need to be honest with ourselves that there's inflation. 12-month core inflation is 6% CPI. That's 3 times our 2% target. Now, it's good to see progress, but let's just understand we have a long ways to go to get back to price stability.
Do you think the soft landing is no longer achievable?
No, I wouldn't say that. No, I don't say that. I mean, I would say this, to the extent we need to keep rates higher and keep them there for longer, and inflation, moves up higher and higher, I think that narrows the runway. But lower inflation readings, if they persist in time, could certainly make it more possible. So I don't think anyone knows whether we're going to have a recession or not, and if we do, whether it's going to be a deep one or not. It's not knowable, and certainly, lower inflation reports, were they to continue for a period of time, would increase the likelihood of a. So I would put it this way: of a return to price stability that involves significantly less of an increase in unemployment than would be expected given the historical record.
Hi, Chairman Powell. Brian Chung, NBC News. You warned Americans of pain earlier this year as the Fed hikes rates, but with the Fed now expected to raise rates higher than you thought when you first said that, just wondering where we are in that pain. How would you describe that to Americans if the projections on unemployment find themselves? That would be 1.6 million Americans out of jobs.
So the largest amount of pain, the worst pain, would come from a failure to raise rates high enough and from us allowing inflation to become entrenched in the economy so that the ultimate cost of getting it out of the economy would be very high in terms of unemployment, meaning very high unemployment for extended periods of time, the kind of thing that had to happen when inflation really got out of control and the Fed didn't respond aggressively enough or soon enough in a prior episode, 50 years ago. So that's really the worst pain would be if we failed to act. What we're doing now is, it's raising interest rates for people. And so people are paying higher rates on mortgages and that kind of thing. There will be some softening in labor market conditions. And I wish there were a completely painless way to restore price stability. There isn't. And this is the best we can do. I do think, though, that and markets are pretty confident, it seems to me, that we will get inflation under control, and I believe we will. we're certainly highly committed to do that.
Thank you, Mr. Chair. Grady Trimble with Fox Business. You've reiterated today, and the committee has reiterated its commitment to that 2% inflation target. I wonder, is there ever a point where you actually reevaluate that target and maybe increase your inflation target if it is stickier than even you think it is?
That's just so changing our inflation goal is just something we're not thinking about. It's not something we're not going to think about. We have a 2% inflation goal, and we'll use our tools to get inflation back to 2%. I think this isn't the time to be thinking about that. I mean, there may be a longer run project at some point, but that is not where we are at all. The committee, we're not considering that. We're not going to consider that under any circumstances. We're gonna keep our inflation target at 2%. And we're going to use our tools to get inflation back to 2%.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. As you monitor wage growth and unemployment data, I wonder if you're paying close attention to a sector or even income level. Like, how do you factor potential exacerbations of inequality into your risk calculations, especially given the K-shaped recovery of 2020?
So I would go back to the labor market that we had in 2018, 19, 20. So what that looked like was wage increases for the people at the lowest end of the income spectrum were the largest. The gaps between racial groups and gender groups were at their smallest in recorded history. All of that because of a tight labor market, which had inflation running, just a tick below 2%, and the economy growing right at its potential. So that seems like something that would be really good for the economy and for the country if we could get back to that. And so that's what all of us want to do. We want to get back to a long expansion where the labor market can remain strong over an extended period of time. That's a really good thing for workers in the economy, and we'd love to get back to that. That's what our goal is. There's in the near term, we have to use our tools to restore price stability, but we can't. What we have to think about is the medium and longer term. If you think about it, the country went through a difficult time. I think much more difficult than we can think it would happen here, but it really set up our economy for several decades of prosperity. So price stability is something that really pays dividends for the benefit of the economy and the people in it over a very, very long period of time. And so when it is lost for whatever reason, it has to be restored and as quickly as possible, which is what we're doing. We do. Yes, we absolutely do. We look at, it's our regular practice to talk about unemployment rates by different groups, including racial groups and that sort of thing. We do. We keep our eye on that.
Hi, Nancy Marshall-Genzer with Marketplace. What would you do if the economy slows so much that we enter a recession before we see strong, consistent signs that inflation is slowing? In other words, stagflation.
So I don't want to get into too many hypotheticals, but it's hard to deal with hypotheticals. So let me just say that we have to use our tools to support maximum employment and price stability. I've made it clear that right now the labor market's very, very strong. You're at near a 50-year low, where you're at or above maximum employment, in 50-year low in unemployment. Vacancies are very high. Nominal wages are very high. So the labor market is very, very strong. Where we're missing is on the inflation side, and we're missing by a lot on the inflation side. So that means we need to really focus on getting inflation under control, and that's what we'll do. I think as the economy heals, the two goals come more into play. But right now, clearly the focus has to be on getting inflation down.
Thank you, Chairman Powell. Greg Robb from MarketWatch. You spoke a little bit ago. You said that the U.S. it looks like we have a structural labor shortage in the economy. Could you expand on that, talk a little bit more about that? And really, are you talking about getting Congress action on increasing like legal immigration, things like that? Thank you.
So what I meant by that, the structural labor shortage, is if you look at where we are now, as I mentioned, if you just look at demand for labor, you can look at vacancies plus people who are actually working, and then you can take supply of labor by are you in the labor market, are you looking for a job or have a job, and you're more than 4 million people short. We don't see, despite very high wages and an incredibly tight labor market, we don't see participation moving up, which is contrary to what we thought. So the upshot of all that is the labor market is actually, it's 3.5 million people at least smaller than it should have been based on pre-pandemic, just assume population and reasonable growth and aging of the population. Our labor force should be 3.5 million more than it is. And that there are lots of easy ways to get to bigger numbers than that if you go back a few more years. So why is that? Part of it is just accelerated retirements. People dropped out and aren't coming back at a higher rate than expected. Part of it is that we lost 500,000 people who would have been close to 500,000 who would have been working, who died from COVID. And part of it is that migration has been lower. We don't prescribe, it's not our job to prescribe things, but I think if you ask businesses, pretty much everybody you talk to says there aren't enough people. We need more people. So I tried to identify that in a speech I gave a month ago, but I stopped short of telling Congress what to do because they gave us a job, and we need to do that job.
Jennifer?
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You say you expect growth of just 0.5% next year. Given that you said the process of raising rates and getting inflation back under control will be painful, have you had discussions within the committee and addressed how long and or how deep of a recession you would be willing to accept?
No, I mean, what we do is we make our forecasts and we publish them quarterly. And if you look at those forecasts, those are forecasts for slow growth, for a softening labor market, by which I mean unemployment goes up, but not a great deal. And you see inflation coming down. You see rates going up a lot. You see inflation coming down. Those are those forecasts, and that's really what they show. We're not. We all, of course, we don't talk about this kind of a recession and that kind of a recession. We make those forecasts. The staff runs, and you will see this if you look at the old Teal books, runs alternative simulations of all different kinds at every meeting, and we look at those too. And those will explore different things, but that's just upside and downside scenarios. Of course, that's responsible practice that we've carried on for many decades. But no, we don't. We haven't asked ourselves that question.
Go to Jean for the last question. Hi, Jean Young with Market News. I wanted to ask about the SEP again. If you are reaching peak rates around 5% in the first half of next year and inflation starts to decline materially, that would seem to make the real rate gradually more restrictive. Is that something that's built into the projections and into models? Is that something you would want to see?
So we do know that, of course, that's something that we know and we'd see. But as I mentioned, I wouldn't see the committee cutting rates until we're confident that inflation is moving down in a sustained way. That would be my test. I don't see us as having a really clear and precise understanding of what the neutral rate is and what real rates are, so that it would mechanically happen like that. It'll be a test of for cutting rates. I think in the event it'll be a question of, do we actually feel confident that inflation is coming down in a sustained way? Thank you very much.
All right. Give me 1 second here and get this buttoned up. Well, that was fun. Give me 1 second. Let me jump my microphone over to the better one. All right, you guys can still hear me? Just making sure. I'll do a quick little recap here for everyone and go over it all. And by the way, you guys are hilarious in the comments. Thank you. Thank you for making that actually entertaining and not as painful as it was. Let's see here. All right. I'm going to end up making this a video for later, so I'll start it over. Hello, Oracles. How's it going? So, yes, we just had our discussion with Jerome Powell going over the rates. I'm going to run down the notes that we've got here really quick. So, based upon what Jerome Powell was saying, looks like, so we got our 50 basis point hike. The market clearly didn't like it all that much, which, you know, we kind of expected it, but it's rebounding now. Actually, looking at it right now, we're starting to come back up about flat across the market, and Tesla's back to 158.50. So we may see a little rally going into the end of the day. Don't really know for sure there. So looks like based upon what we had seen, we are going to be looking at the 50 basis point hike today. He said by the end of next year, probably a 5.1% federal funds rate. That means that we're probably looking at another maybe 75 basis point hikes during next year. So we might see a 50 basis point hike in February. By the way, the next meeting is going to be January 31st to February 1st. So February 1st, we would get that next rate hike. Could be another 50 basis points. And then in mid-March, we're going to be getting the next one, and that could be another 25 basis points. So I'm anticipating, and this is kind of how I've been feeling it out for the entire year as he's been speaking. And if you guys pay close attention, he really hasn't changed the words that he's been saying. He's just kind of changed his stance and his presentation of those words to be either hawkish or dovish. Today was definitely a hawkish version of those same words. And so it hasn't really changed, though, because he still said that they're going up on those rates and the pause will come next year. And then they're going to have an extended period of time where we are going to be seeing high interest rates. So my prediction is going to be the same basically as was before. We're going to be seeing 50 basis points probably end of January. We're going to be seeing 25 in March. And then we'll see a pause for probably 9 to 12 months. You know, it's going to be, you know, obviously data points coming in. We've got to make sure that inflation's coming down. If we end up hitting that inflation cliff and we come down hard, maybe they pivot sooner. Otherwise, I have a feeling we're going to end up seeing ourselves in a position where we're going to have rates about that 5% level, probably through maybe February or March of 2024. And at that point, they'll start to come down on the rates. So he did say at the end of 2024, the goal is to be at 4.1%. So that means that in 2024, they'd come down 100 basis points, and then 3.1% for the end of 2025. So that would be another 100 basis points coming down at that point. So that's kind of what we're looking at right now. And of course, obviously we'll monitor as we go along, but that's kind of what I'm looking at for interest rates over the next 2 years. Where it comes to Tesla playing into this, I have a feeling it'll kind of go along with that. As we've seen this year, interest rates went way up, Tesla came way down. Remove the drama that's going on right now from it, because that drama should be ending most likely. I would guess timing-wise, the Twitter and Elon and all that drama will end right around the same time the Fed is going to pause rates. Timing could be really good. So we might actually see a nice little push coming in the stock. When we get to, you know, that March level, that might be the bottom. We might not be at the bottom yet. So just brace yourselves. Might not be there yet. So might still have a little ways to come down, but seems like that's what's going to be happening. So we're going to have to be patient. Patience is going to pay off. We're going to have an extended period of buying opportunity. So anybody who's looking for the stock to run back up and go to the moon, it's going to get there. It's going to take some time. So just brace yourselves. But I still have faith that's going to get there. Like Elon said, long term. Look long term. Long term isn't 2 to 3 years. Long term is 5+. Sorry about that. So it looks like he said no focus on rate cuts next year at all. So for anybody who was thinking that, and I was thinking that, I do still think that if we get to that cliff and we have interest or we have inflation come down a lot faster than we have thought of, we might see that pivot come sooner. So there might be the rate cuts. But as of right now, the Fed is not even looking at rate cuts at all next year. Let's see. And I can't remember who said it. I'll actually go through the comments because it was a riot. I think it was Lawrence. Lawrence with the, yeah, Powell keeps saying the tools that they have. He's like, you got one tool, dude. The only tool you got is raising interest rates or lowering interest rates. Your tools. That is about it. The other tools that you have are all the other members of the FOMC. So let's see. And so again, we're in a very strong labor market, and that's kind of where the hiccup is right now, because we want to keep the strong labor market. We don't want to get rid of that, but because the wage inflation is there, we kind of want to mitigate that. We don't want it to go up too high too fast, and we want to make sure there's the balance. So as inflation comes down, if we can maintain the strong labor market as inflation comes down, that's ideal. And I hate to say it, but realistically, at the way we're going, we might get that soft-ish landing. When I say soft-ish landing, I mean we're kind of in that little bit of a recession right now, but it might not get to be a really bad recession. Elon and Kathy Wood seem to think we're going to get there. I think if the Fed keeps on raising rates and inflation comes down really fast and they don't pivot soon enough, we could get there. But I don't know if we're going to get to a massive one. Something I'm going to monitor, but there's a chance. There is a chance. I hate to say it, but there is a chance. It's still not going to be pretty. And even Jerome Powell said it himself. Got to give the guy credit. He says it's going to be painful. Brace yourselves. It's going to be painful. He's letting us know it's going to be painful. And yes, as Stuart says here, sorry about that. I'm still getting over my cold. If in doubt, zoom out. Again, I always go back to holding a plank. Anybody who has done workouts and exercise, holding a plank for even just a minute sucks. Very painful. But it's worth it in the end. But during that time, it just seems like that time lasts forever. We just happen to be in a very painful time right now, and it just seems like it's going to be lasting forever. That's all. Let's see here. What else do we have for comments? Yes. So you're saying there's a chance. There is. I'm not giving it a high probability because, again, as you guys all have mentioned, there's a lot of things that are political that are involved in this, and who knows what other things are going on. Not to spread conspiracy theories or tinfoil hat stuff, but I don't know if they're looking to force a recession. I don't think they are, but could be an outcome from this. He's mentioned it before as a possibility. He didn't mention it so much today, but it's something that has to be on the radar as something that could end up happening. This is a good one. Yes. So Happy, do you think that these rates, with these rates, Tesla will decrease the price of their cars in 2023 or increase them? Decrease. So my theory, once I started seeing what was going on, if we do get, especially if we can do a recession, they'll probably come down on it. We've got Project Highland, which is going to come out, which is going to make the Model 3 more efficient. That is going to be more efficient to make, lower the cost. That in turn is going to allow them to come down on prices. Because of the fact that we might be getting into a high interest rate environment with potential recession, it's obviously going to be really more detrimental for legacy auto and startups. Startups in particular, like they could be in real trouble. I think this is one of the reasons why Elon is fearing with Twitter is kind of in that same startup scenario right now. Lots of debt, a lot of issues with not enough money coming in to pay for their bills. They could be in danger of going bankrupt next year. A lot of these startups that we see are in that same position. So what could end up happening is if we get to a point where the labor market is still hot and wages go up, maybe we don't see the prices come down too much. But if demand starts to wane just because people are maybe protecting their money, maybe not spending as much, kind of waiting to see how things are going to go out, that may cause demand to come down. That may cause them to need to pull their prices down. So I'm anticipating a price decrease probably Q4 of next year. That's my guess as of right now. What's nice is, like, I was looking yesterday, and there's a lot of inventory of Teslas out there right now. So if I wanted one, I can go get one this weekend. So it's kind of nice to have that. From an investor standpoint, I did like to have that 6 to 8 week lead time. But from a consumer standpoint, I can go get one tomorrow. Not a big deal. So you got to kind of balance the two there. I think we're going to be at that point for the majority of next year. But again, got the EV tax credit starting next year. So who knows how that's going to play out with EV tax credit. We'll have a better idea of all of that probably come, let's say, February. So after maybe the next FOMC meeting on February 1st, we'll have a better idea as that. But I do think they're going to come down on prices next year. Let's see. Thoughts on the Cybertruck? So I think the Cybertruck, we're going to end up seeing first production and deliveries coming in July. That's my anticipation will be July. We'll see them. And pricing on it, I think they might actually start the dual motor at 69,000. That would be my guess. Probably 69,000 for the dual, maybe 89 to 99,000 for the quad motor. And then if they're going to do a plaid, probably 119 or 129. Just based upon Rivian's pricings for what they've got, what Tesla said that they have going on for their stuff. That would be my guess. Again, obviously nobody knows. That's just a guess, but I would guess that. And honestly, that's going to really help with margins. And maybe that will help with them making the decision to come down on the prices of vehicles also. You know, if they're going to get the EV tax credit, they're going to have even more pricing power than they do now. So there's a lot that Tesla has that's in their control, which is nice. And, you know, if they want more demand, they can make it. If they want less demand, they could do it. But I do not foresee prices going up on their vehicles anytime soon. Jawad, what was the maximum lowest point for Tesla stock? So if you guys follow me on Twitter, you saw this today. This was literally my tweet. Actually, I can probably bring it up and show you guys because we're on a live stream. Let me get this up here for you. Let's see here. Come on. Yeah, lowest price, I truly don't know. And my computer is going super slow now, so sorry about that. But yeah, lowest price, realistically, why are you not working? Oh, that's why, because I'm doing a live. So by the way, guys, I'm actually live streaming this on Twitter also. That's why I can't see it. But what I said on the tweet was the lowest point of the stock is going to be when we don't go down anymore. That's it. That's all I know. Once we get to the point where we're not going to go any lower, that's where we've hit the bottom. So where that is, I don't know. Nobody knows where that is actually going to be. There's been a lot of discussions lately about people getting margin called. There's a lot of other people, more than I thought, that were out there that are on margin. A lot of people, a lot of big money people have a lot of margin in Tesla. That could be a big reason why we saw such massive dips recently, was a lot of margin calls going on. No confirmation of any of that, but just hearing the chatter that's out there, that may be a big, massive reason behind this. Still no Form 4 filings at all that are out. So, you know, I'm going to keep on paying attention to this to see what's going on. But yeah, that's bottom. Don't know when. Timing wise, if we're going to be hitting the bottom at some point, I would say it'll happen by the time the Fed pauses. So if my predictions are right, I would say March will be when we hit it. If not before then. But where that price is going to be, I don't know. Not a clue. Right now, the way my strategy is, I have half of my cash I'm going to deploy at 140. Obviously, I'll monitor. If we're like really crashing down or something major happens, I'll hold. But but as of right now, it is 140. I'm going to deploy half of my cash, and then I'll start building it back up again to that 10% level, because right now I'm at 10.6%. So at that point there at 140, I'll deploy half of my cash and then build it back up and see where we go from there. Let's see here. Leo wasn't one of them. Actually, from what I heard, Leo was one of them. I didn't want to throw names out there, but I heard that he was one of them. So I don't have confirmation of that, but that's what I have heard. Huge rally tomorrow. All in all, this, I wouldn't say it was really good news, but it was expected news. So we may see that rally tomorrow. You know, let me take a look at the market now, and we've fallen back down. So I don't know. The market's all over the place, whether we're going to rally or not. Looking day to day, who knows what's going to happen. At this point here, we're at the mercy of the market. Yeah, exactly. Huge market manipulation. And I think that's really what they're coming down to is they're really, I mean, you got to remember market makers have access to a lot of information that we don't. They can see where sell orders are. They can see who is on margin and how much margin is out there. They can see all of these different things. And if they see that there's a massive margin call for people at 150, then they're going to go there and they're going to do everything they can to drive that stock price down to trigger those margin calls. Once that happens, we hit a domino effect where it'll set off even more margin calls. It'll set off other sell orders that people have out there. Some people just protecting themselves and say, if it goes below 145, I want to sell. Margin call hits at 150, brings it down to 145. Those sell orders hit, triggers those, falls down to 140, triggers more orders there. It just hits that domino effect, and it could topple down from there. So again, a lot of that is not a fundamental reason why the stock price is coming down. That is a market manipulation of people protecting themselves and other people who have put themselves on margin in a market they really shouldn't have been in margin, and the market makers just flushing a lot of that out. So again, you still have to look at the fundamentals, and it sucks for the stock price, but realistically, the fundamentals of the company, they're still doing really well. Let's see. Cryptomaniac, huge market rally coming. This is a bear trap. All excellent news, in my opinion. Going to load calls for January. I don't do much with options, but I totally agree with you. Again, this was expected news, and we're getting what we're getting. Again, we saw the CPI, inflation, everything is moving in the right direction where we need to be going. Especially for Tesla, we're in the oversold range, or we're really, really close to that oversold range. So I think for Tesla in particular, we're going to end up seeing a bump coming, whether it's going to be another one of those dead cat bounce bumps, or if it's going to be, maybe a leveling off. I don't know, but I would expect a little bit of a bounce coming very soon for Tesla. Time to the moon, U-shaped recovery. So realistically, we were talking about it during the live stream as well. What typically is going to happen is we're going to see the Fed's going to come out and they're going to pause. We're going to get that pause, and then as soon as the market anticipates, based upon inflation data, labor data, all of that, when they see that in 6 months, the Fed will most likely be doing a pivot, at that point, we will start to see the rally coming. So from the 6 month prior to the anticipated pivot, we'll see a rally going into that. Once we get to that pivot point, there will be the sell-off. It's literally going to be a buy the rumor, sell the news situation. And it's going to look very similar to what we see from a stock split, where it's going to end up falling off. It'll fall pretty hard, but we'll have that V-shaped bounce like we saw for COVID and come back up. As we come back up, when we get back to the level that we were at prior to that pivot dip, we will see the market. If the market seems healthy, like we can go into a bear market or into a bull market, sorry. If we come back up to that point and we see, all right, we're in a healthy economy for a bull market, we will continue up into that bull market. So these are just the things to anticipate. Again, just something I'm going to be watching for the next basically 18 months at this point. I think we have an 18-month stretch right now where we're going to see 3 months rate hikes. It's 9 to 12 months of flat rates, probably around that 5% level, and then start to see the dip down coming. So again, that's my anticipations based on the information we have right now. Are we going to see 200 for Tesla end of year? I don't know. My gosh, my price target currently is 205, but we got 2 weeks to make up a lot of ground to get to 205. So we need a massive Santa Claus rally coming, and we're going to need some really good positivity coming out of Tesla. And I got to tell you, the sentiment right now is in the pooper. We have some pretty garbage sentiment. You guys know it. It's a friggin' dumpster fire. I've been posing questions over on Twitter. If you guys are over there, I'm trying to throw out a lot of, not my viewpoints, but just questions to kind of get people's minds moving. My whole Oracle name is kind of based around that. I don't want to give you guys, I can't give you the answers. I don't know what the future holds, but I can present to you guys different scenarios and perspectives that can kind of just at least make you think and make you think about the different things that are out there. And that's really what it was is, when it comes to Elon and all the antics that are going on over on Twitter and the things that he's coming out with, and the fact that we're hearing about how it's really tarnishing Tesla's brand. Is it really Elon's tweets themselves that are tarnishing it? Or is it so many people talking about Elon's tweets and spreading that is causing the tarnishing of the brand? I don't have an answer to that. Obviously, if Elon didn't tweet it at all, it wouldn't be out there and we wouldn't be spreading it. But we even have a lot of bulls that are complaining about what Elon is saying. If the bulls just shut their mouths and didn't say anything about it, it would spread less. Obviously, mainstream media is going to pick it up and put it out there. But the more everybody talks about it, the more you have about it. It's like stress. The more you stress, the more stressed you're going to be. So the less we talk about it, the less it may tarnish the brand reputation. So just my perspective on that. And just, again, some things I like to throw out there as thoughts for people as to, maybe some of the actions that I'm doing. And I try to do it here on the channel because every once in a while I'll catch myself and say, maybe if I didn't talk about certain things, despite the fact that it is something that, is a question that's out there and I want to bring it up and address it. But maybe if I talked about it less, it may not be as big of an issue because I can be one of those proponents of pushing it out and spreading it more. Just a thought. Let's see. I'm not going to hang out too much longer. I have to go pick up my son. Actually, my son's going to be starting his own YouTube channel. If any of you guys are Yankees fans, once he gets it up and running, I will let you know if you want to support him as well. So we're going to be doing his first video today. So very excited about that. Let's see. So that's really it. So I'm going to jump off in a second. I'm just going to go through my notes, make sure I didn't forget anything for you guys on here. Rate hikes, GDP. And yeah, so it does look like, and the housing market still has to come down also. So obviously interest rates going up has helped with that because when you have higher interest rates for mortgages, prices of the houses usually come down. So I've talked to a lot of real estate agents and they're anticipating probably a 15 to 20% drop in housing prices in 2023, especially if rates are going to stay high. So this is ideal for me. This is what I've been waiting for. And the main reason I have not purchased a Tesla yet, because I want to have as much cash on hand as possible to take advantage of the housing market. Because you buy real estate is another very good income generator that will in turn allow me to buy a Tesla and even more Tesla stock, because I don't think the stock price is going to go parabolic again till well after the housing market has hit its bottom. So timing wise, it could be really good for me to get into real estate and then take that real estate income and put it into Tesla stock before we get that parabolic jump. Just my current plan in anticipation. Yes, Stuart. Hot water and lemon and honey. I know, and all this talking, I try not to talk too much, but I get so excited and chatting with you guys, I can't help myself. Let's see. Don't see Tesla going back above 200 until 2024. We'll see. I think we might get there before 2024, but could be a while. Unless we get something massive to turn around in the sentiment in the stock, it's going to be a while. But I think we'll get there before 2024, but who knows at this point? I could be wrong. Let's see. Oh, here we go. It's a good one. Do you still foresee another split in 2 years? And when is the Fed stopping rate hikes? Is the USA recession in the UK? So recession, we're kind of basically in one right now. It's not terrible, but we're kind of in one. I think we're going to probably, if we may get a little worse depending on how it goes, but it may just kind of be like blah, like it is right now. It might just be like this for the next year to year and a half. So it could just suck, but not like super suck. The split, I think, and I was talking to somebody before, based upon how long the Fed now anticipates having the interest rates high, I think we're going to end up seeing a split probably. I originally thought 2024. With this extension here, I'm going with 2025 if we do get the economy turning around by when I anticipate, which is early 2024. If we get it then, I think 2025 will see a split, if not 2026. So instead of having, I thought we would see 4 splits. It's now down to 3, maybe 2, depending on how Tesla plays it with buybacks and everything. But lots of other questions in there. Thank you, Mark. I appreciate that. I appreciate all of you guys. You guys are awesome. And I got to tell you, you guys are phenomenal. And you guys keep me going. Oh yeah, France, Morocco. This is a big one. I got to go get my kid, and we're both rooting for Morocco. We were looking for Argentina and Morocco, but I know Morocco's facing a very, very good France team, so we'll see if they can pull it off. But don't forget, Morocco hasn't given up any goals whatsoever this entire tournament. The only goal they've given up is an own goal. All right, last question. I'm going to get out of here. Buyback really coming? You're not? Yes, buyback is coming. The 2 problems that we have right now is Elon potentially having to sell more shares to be able to make sure Twitter does not go bankrupt. Tesla's not going to be buying back any shares until they know Elon's not selling anymore. So obviously they have good communications with that. We just don't know that. The second piece is because of the fact that interest rates are going to still continue to go up, it doesn't make any sense to do a buyback until we get to that pause. So my guess is unless they announce something surprise by the end of this year, we'll probably hear about it maybe on the Q4 earnings call. And they'll say, hey, we're going to start doing a buyback with a plan of $5 to $10 billion, whatever it is. Because don't forget, Elon's been through some very difficult economic times with his companies, almost going bankrupt a lot. He wants to make sure that they are all very well protected. And protected means that a lot of cash on hand just in case something gets worse than they think. Tesla right now has a ton of cash on hand, but they don't want to dump half of their cash into a buyback right now if we're going to get into a worse than expected recession next year. So once the board and Elon see that we are not going to be getting into the recession that they are anticipating as a worst case scenario, that will give them the green flag to go ahead and do the buyback. That's, I think, what's playing around in their head right now. Again, I'm just speculating all of that, but based upon the information we know about Elon, his prior companies, him selling shares, we're going to get a buyback. That's almost guaranteed for 2023. It's just a matter of when they're going to do it. Let me see. What was the board of directors meeting rumor? The only rumor that we knew of was Elon was coming onto a Twitter space and got on late and said, sorry, I had an urgent board call meeting that he had to be on. That was it. So he had the board meeting call that was urgent, and then he ducked out of the last Twitter space to go onto another board meeting call. What they're about, I don't know. I would anticipate buybacks. I would anticipate everything else that's going on. We are coming to the end of the quarter, don't forget. There's a lot of different things they have coming up for the quarter. You know, what's going on in this region, that region, all sorts of other things that are going on. So it might not even be related to buybacks. Don't know. But we're just at the end of the quarter, end of the year. Lots of different things that I'm sure they're discussing. Let's see. All right. That is it for now, folks. Thank you all so much for being here. Glad I was able to hop on early for you. I'm going to actually chop off this second half and I'll put it out there as a video for anybody else who wants to watch it as a recap. So thank you guys all for being here. I will see you all later.